All right, welcome back. Now, talking about taxation of investments. So, when we think about the return that a client is getting from an investment, if an investment is taxed heavily, the growth of an investment is taxed heavily, it may not be as potentially benefit for a client. If an investment return or their compensation is taxed favorably, a client should look at that as a positive. So it's something to be considered. We need to focus on after tax return, not just the gross return. If you consider, if you were to give a client a 5% return on their investment, but it comes in the form of interest that is 100% taxable, and compare that to a 5% return from a different investment that might be in the form of capital gains that is only 50% taxable, the client should choose to invest in the second choice, not the first. If we think about T-bills, bonds, and some mutual funds, if they were receiving interest, it is fully taxable. 100% of the interest is added to their income for the year and is fully taxable. If you think about dividends from Canadian corps, it's taxable, but it's a reduced tax amount via the dividend tax credit, which we have talked about in a previous chapter. And then if you think about investments like stocks that return capital gains, only 50% of the gain is taxable. So again, thinking about after-tax return, not just gross return on investments, is extremely important when comparing different options for clients. Some of the different calculations you'll need to know for this chapter and for the exam. Calculating return. So a basic formula for a rate of return would be cash flow plus ending value minus beginning value divided by the beginning value times 100. That will give you the rate of return. So for an example, if you were to buy a $10 investment or a $10 stock and then sell that stock or investment at $12, what would the return be? So cash flow, there is no cash flow in that existing example, but the ending value is 12 minus the beginning value of 10 would give us 2. We would take 2, divide by 10, and then multiply 100. That gives us the 20% return. If you want to take a bit of a different example that has cash flow involved, if we were to buy a stock at $10 or any investment at $10, later on sell it at a loss of 9, but we received a $2 dividend in the meantime. So how we would calculate that, we would take the cash flow of 2 plus ending value minus beginning value, which would be 9 minus 10. It would be divided by, again, the beginning value of 10 and multiply by 100. So in that example, considering the loss of the stock itself, but receiving the dividend, it actually gave us a return of 10%. Different averages. Again, I'll stop there for a second and just say there is going to be or are going to be multiple video links as well at the end of this lecture that will go into some more details and examples of calculating rates of return. Different types of averages when we're talking about rate of return. Arithmetic mean is also known as just the simple average, and geometric mean is the average compound return over time. So again, the difference we'll show some differences, but the simple arithmetic mean is an example of above where we're simply calculating the simple rate of return. Geometric mean is when we're going to look at multiple years and we're going to look at compound return over time, meaning that there's going to be returns over multiple years. So we have to calculate the average return of that. So, and again, don't worry too much about the math on this one, but Compound return means that you will be earning um, growth on the previous year's growth. So, for example, if you have an investment that's initially at $20,000, and over 5 years you have a return sequence that's listed of -20 through to -9, +7, +18, and +31, you'll end up with that $20,000 equaling 23,179.24. The reason for this calculation and the fact that it's not just simply looking at the average of the returns and multiplying that by the 20, you have to take into consideration the sequence of a return. So you would first calculate 20,000 at a -23% return, taking the answer that you get there, looking at year 2 and multiplying that by a -9% return, taking that answer, multiplying it by a +7% return, followed by +18 and +31. So again, not simply just 20,000 times each of these percentages added together. You have to do it in sequence to get the right answer. And again, I'm going to be adding some video links at the end of the lecture in order for you to have a better understanding of compound return. So if we think about portfolio return calculation, this is the formula that you will need to understand. It's the expected rate of return of a portfolio. R1 times W1 plus R2 times W2 plus, and so on and so forth, where R is the expected rate of return on a particular security, W is the proportion or the weight or percentage of the security held in the portfolio based on the dollar investment, and N is the number of securities in the portfolio. Again, we will see a link following this lecture to give you a better idea of portfolio return calculation. So measuring equity volatility. So again, what is equity? Equity is stock. How do we measure the volatility of stocks? One thing we have to consider is the variance. What is variance of a stock? It measures how far returns deviate from the average. So again, it's comparing a specific stock or equity position to other average stock or equities, and how much do the returns vary from comparisons. That gives us one level of volatility, again, variance. Another measure would be standard deviation. It's the square root of variance. So it takes the first measure of volatility, variance, to another level. And the higher a standard deviation is of a specific investment, the more volatile that will be. Now, if we look at the example on the right, if we look and compare fund ABC versus fund DEF, we see they both have the same average rate of return of 12%. So on the face of it, it might look like it is returning the same, but what about the volatility? So if we compare standard deviation, the ABC has a standard deviation of 10, and DEF has a standard deviation of 4%. We know that, again, from just what we discussed, a higher standard deviation means more volatile. So the range of returns for stock or fund ABC will be between 2% and 22% because it has a higher standard deviation. It's going to be more volatile, even though the average comes out to 12%. DEF, on the other hand, has a lower standard deviation. The returns are going to range between, say, 8 to 16%, even though it will return the same when you average out the years at 12%. So comparing fund ABC and fund DEF, although they both will have the same outcome of 12% average return over many years, choosing one with a lower standard deviation means that fund would be a better selection because it will have a lower volatility measure. It won't bounce around in price as much. And typically, what happens when prices bounce around significantly is investors get spooked and scared and make decisions based on that. So, again, lower standard deviation would typically mean lower volatility, which typically would be a better selection than an investment with a higher standard deviation. Make a note that standard deviation is a favorite for the final exam. Third measure of volatility we discussed is beta. It measures the stock fund movement relative specifically only to the market itself. So market beta is one. So if you think about the stock market in general, every investment all together, the market moves at a beta of 1. So if a stock is more volatile than the overall market, it would have a higher beta. If a fund or a stock has a lower than 1 beta, that means it moves less. It's not as volatile as the market in general. Again, our example here, if the beta is 1.5 and markets rise 10%, the fund would rise 15%. But if the market drops 20, the fund drops 30%. Again, more beta greater than 1, higher market volatility than the overall market. Beta for an investment less than 1 means that actual investment will be less volatile. The movement will be less than the overall market. Gonna get out here and come back in again with another recording just so we have, again, not too much space taken up. I can upload these multiple files. I'll see you in a second.